Hello and welcome to Livewire's newest series, Views from the Top, a series dedicated to bringing you the best of the best ideas and insights from those at the top of their game. Today we're very lucky to be joined by FNArena's Rudi Filapek-Vandyck for a deep dive into the reporting season and what you can expect. Thank you so much for joining us today, Rudi.
It's a pleasure.
Very, very excited. You told me I should be surprised, both excited and nervous, but let's get straight into it. The big picture. The market is looking through all the headwinds that we're seeing right now and betting big on rate cuts in 2024. Is there anything wrong with, sticking to consensus?
It's not necessarily wrong, but we have been here before. Just a short memory back. February 2023 last year, August 2023 last year. In both cases, the setup was basically the same. We get a big rally leading into the reporting season. And then, of course, the reporting season turns out not good enough to sustain the share prices. And then we basically erase all the gains we had, and then the process starts again. So it's not inconceivable that we will have a similar process now. We have basically rallied on macro considerations. From the bottom up, there's not an upgrade cycle happening in economies and in profits. But there's two things I think that are different now. One is that the carrot of interest rate cuts, whether that is short term or medium term, the carrot is there, and I think that will, to a certain extent, will support share prices. And the other thing is that we've actually, I know it's very early days, but we've actually made a good entrance into the reporting season. Reporting season starts really slowly and gradually in Australia. So we have a very small sample, but the early signs are there that companies tend to do better than forecast, or at least met or meet expectations. And so far so good, but again, small sample, but at least we had a good start.
Okay, we'll get into some of that granular detail later on. But I want to talk about what you can expect going forward. We saw value being tipped as, the area of the market that would outperform in 2023. It didn't. Growth and momentum outperformed instead.
Yes.
What can investors expect this year, and did that surprise you?
In my view, and that's probably a little bit different from what the majority of the experts views. See, in my view, we're going through quite an exceptional era. And the era is of technological innovation. I've made the comparison in the past a number of times. I think the best comparison we have are the 1920s. And the 1920s was this great era of technological innovation. It also meant it was a great era to be a shareholder in the share market. And a lot of companies, of course, they had tremendous growth on the back of new developments that were reshaping society, essentially. Reshaping society and then also the share market and economies. We are going through a similar phase now, I think. That has as a consequence that high growth driven by megatrends and technological innovation is not going to go away. So this whole discussion about whether we should go into value, which basically are either cyclicals or old economy companies, or high growth companies that promise the future. I think this whole discussion is a bit warped, and on occasion we will see the pendulum change between those two extremes in the share market. But I think on average, longer term, sustainably, I think you can't calculate away, you can't ignore the fact that we are going through this tremendous exciting time, and technology should be on everyone's radar, I think, and those companies will continue to perform, and they will never be priced at 9 times next year's profits.
Another area of the market that everyone says investors should be looking at right now is small caps. Mm-hmm. Do you agree with that?
It's probably universal forecast, small caps, and it's not such a difficult one. We've had 2 years of a tremendous bear market for small caps, and you don't have to be a genius to work out at some stage that corrects itself. So small caps, yes, Other universal forecasts are comeback of REITs, yes. Comeback of healthcare, yes, in particular quality healthcare. Comeback of small cap resources and comeback of emerging markets. All those forecasts are probably correct, but they won't be universal. And I think the mistake investors will make, probably, is thinking that by default, there's only gains to be made in small caps. There's only gains to be made in REITs. There's only gains to be made in healthcare stocks. And that will not prove to be the case. So I think selection and be selective will remain very important, I think. And the most important thing to add is that there's still a lot of growth and upside to be had out of large caps, out of growth stocks, out of technology, and that will not disappear. So I think the best strategy maybe for this year is diversification across all those themes, not just picking one of them, because again, it won't be universal and it won't be all at the same time every single time throughout the year.
If it's not universal, which companies do you think will outperform them within those sectors?
Well, I think I just mentioned healthcare. Healthcare is always on my radar. I think we've already seen that with ResMed.
But that's also been a consensus call.
Yes, exactly. So that's quite an easy one. Well, easy one. If it was that easy, I mean, we don't want to pay $1 for everyone who wasn't in ResMed. CSL is making a comeback. I mean, it's visual. It's above $300 now. The market is preparing for a very strong result from Cochlear. Outside of that, we have the REITs, and I think the last 3 months or so, I've already seen quite some share prices move there. The market leader is Goodman Group, and they continue to perform. And again, expectations remain quite positive. If we go to small caps, I mean, we have the laggards, the ones that haven't performed, or maybe a little bit, and that's where everyone's attention will go, of course. I mean, if I look through all the forecasts that I'm going through now ahead of February, companies that are often mentioned are the travel industry, it's corporate travel, Webjet. A company that is definitely often mentioned is Hansen Technologies. Everyone sees it as a quality company, and its share price is not moving, essentially. You can add a few more in there. If we just mentioned ResMed, my candidate for the next ResMed-alike recovery, if you like, might be IDP Education. I think at the moment the market is very uncertain how to deal with the uncertainty, and once that becomes more clear, I think that could potentially be the next ResMed, but not necessarily in February. It might require more time. But there's also the other side of the small caps, and I just mentioned growth, technology, mega trends. There's quite a group of small cap, relatively small cap companies that already has performed. And I think investors, the mistake they would make is by thinking they've done their dough, because they still have a lot of growth in front of them. And obvious candidates, as far as I'm concerned, NextTC, Macquarie Technology, depending on where you put exactly your demarcation when it becomes a small cap or a mid cap. I think Steadfast Group, AUB, those are the insurance brokers, look very good still. And you have the financial platform operators, Hub24, NetWealth. The mistake to make is because they have performed to date, that there won't be anything coming beyond what already is in the share price. And I think that would be a mistake.
You talked before about share prices not performing as expected post a company beating or missing expectations last year. What can investors expect this year?
That is the big unknown, I think, because officially we're trying, as a community, we're trying to look beyond the short term now. We're looking forward to better times ahead, second half 2025. But that's the big question. I mean, admittedly, we've seen, for example, with disappointing market update by Bapcor, that the share price did not fall, actually went up. So that could be good news. but I still think we will see some fireworks here and there. And for that reason, I think it's only smart to have a little bit of cash on the sidelines. Because if I can go back to last year, both ResMed and WiseTech Global share prices sold off quite heavily. I bought both, and I think for that reason we will see more opportunities coming this year, and you don't know in advance which ones they are. But so the best strategy you have, I think, is to have some cash, and if it happens, buy and be comfortable.
We'll get to your cash holding a little bit later on. I know that it's a spicy subject. Where are expectations too high right now? Where could we see some of those explosions?
That's a little bit of a how long is a piece of string? Because we will have to find out. And as I said, we don't know how the market is going to respond to disappointments and to surprises. But I think as an investor, you have to know your strategy. I mean, is your strategy to sit in undervalued assets and then wait for that to get to fair value? Or, in my case, are you comfortable holding companies that have many years of growth ahead of them, and even if they dip or fall in price after the results, that doesn't bother you? That might actually, for example, I mean, two of my favorite stocks would be Technology One, which is not reporting this month, and the other one is REA Group, which does report in February. Often what happens is the share prices fall after they report results. For me, that's never a problem. Right? If I don't have enough shares, I just buy more. And if you look back subsequently 12 months later, the share price is higher. So how you respond to that is basically the type of investor you are and what exactly is your strategy. But my strategy definitely is that I will keep my eyes open for those structural growth companies. And if they do dip in share price, then I might consider even buying more shares. Or if I don't own them, I might actually buy them.
You talked about having a little bit of powder on the side, just in case any companies sell off on the day. A few months ago, or last August, and I think also last February, you told us you were holding 18% cash, which is quite a lot of cash. How much cash are you holding today, and have you put any of that money to work?
Yes, so I've last year I was pretty confident. Don't ask me why, but I was pretty confident that those rallies we saw each time leading into reporting season, that they would prove futile, and they were basically running on fumes, and it would not be sustained. Now, twice I was correct in that one, but in the second time, after August, I started looking differently at the market, and I thought I'm going to use some of that cash. And I've been, from memory, I've been buying WiseTech Global, REA Group, Hub24, ResMed, Goodman Group, pretty much a lot of companies I just mentioned earlier. So I've been putting some money to work, and I basically halved my cash level to, it's around 9% now. Is that a lot? Well, if you consider that I own about 20 stocks in portfolio, 9% is 2 times 5, pretty much 4.5. It can also be 3 times 3. Right? So it's a lot, but it's not a lot, because I will still have to be selective in how to allocate that money. Assuming that I'm going to allocate it in full after this reporting season, that may not necessarily be the case. So I can be patient. I do think that the overall environment, at least for the time being, has changed. I think the bias is now less to the downside than it was last year, even though last year the real downside hasn't really come through unless in individual companies. But as long as you can avoid the real disasters in that scenario, and you can be confident in using the share price weakness, like for example ResMed, WiseTech Global, I mean, then I think you're an excellent, or you're doing quite a good job in allocating your capital.
Okay, last question for you today, Rudi. We like to ask all our guests, what's something they've learnt in their years in markets, or from those connections they've made after decades working in similar roles? What's your view from the top?
I learned a lot over the past 2 years or so from the fact that share prices of CSL and ResMed last year did not perform for a while. And what I notice is that so many people are focused on price and on charts. And my problem, and what I noticed, is that when you only focus on price action and on charts, you never get to the bottom of what consists of a company, what makes the company, what makes it tick. And unless you get to that point, you find it very difficult to understand why ResMed at $21 is an excellent opportunity, and why CSL at 248 or whatever, how low it was, even at 260 or 280 is an excellent opportunity. Yeah? The charts will not tell you this. The price action will not tell you this, but you have to try to get to the bottom of what makes a company. And sometimes the fundamentals of a company, longer term, and the share price action, they diverge. Yeah? And at that point, it is very important then to understand the fundamentals of a company. And I've learned from the past few years that there are so many people that are being led by price action and by charts, basically, and they literally don't understand the company. I mean, and you have to question, if you are an investor other than a trader, whether that is the right way of approaching the share market.
Okay, well, I've absolutely adored this chat today, Rudi. Thank you so much for your time today.
My pleasure.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.